Welcome back, everybody, to College Refocus, where we take all the good college data, break it down, and create tips and tricks for you to create your own happy pathway. Thanks for joining. Let's get into the topic of choice for today. Subsidized loans, unsubsidized loans, what are they? How am I supposed to use them in my college career? Or if you're a parent, how are we supposed to pay for college? Well, let's get into those topics. Thanks everybody for joining. Okay, so let's talk about paying for college. Well, there's a tier or a ladder system, and I'll put a visual up over here so that you can see kind of where this ranks in the overall ways of paying for college. Unsubsidized loans and subsidized loans are considered a federal loan. Okay, so what's a federal loan? Well, if you need help paying for college, or you just want to delay paying for college a little bit, you might want a loan, okay? And the federal loans are actually backed and offered by the federal government. There are two forms of federal government loans, unsubsidized and subsidized loans. Okay, but what does that mean, right? They sound similar, right? And they even feel very similar when they're on the list of how to pay for college. However, there is drastic differences of who is applicable for each loan and how much percentage of interest rate you're going to be paying. So you got to pay very careful as to which one you have or whether or not you have both. There are so many details around the federal loans that it gets very complicated. So we're here to help you navigate what are these federal loans. So let's start first with subsidized loans. It is for an undergraduate degree only. You cannot use it for a graduate degree. It also has a benefit to it. It has the federal government paying for your interest rates or your interest payments during the course of your undergraduate degree. So if you take out $5,000 your first year in subsidized loans, just as an example, then you will not see any increased interest or increased amount to your loan over the course of the 4 years that you're undergraduate. So when you graduate, you'll still have a $5,000 loan. That's an example. We'll talk about how much money you can get for each, but it has that added benefit. But you have limitations of whether or not you can apply and get a subsidized loan or not. The opposite is an unsubsidized loan. You can use it for an undergraduate degree or a graduate degree. So there's an added benefit there. But like there was a benefit for the subsidized loan of the fact that the federal government was paying for your interest rate, an unsubsidized loan, you have to pay. So that $5,000 loan, as our example, will be larger when you graduate. So keep that in mind. There are some benefits and disadvantages of each side. So how do you apply for a loan like this? Well, it's quite easy. The student and the parent have to fill in what is known as a FAFSA. And when you fill out that FAFSA, it will automatically apply you for the federal loans. So you'll get notification of whether or not you have the capability of having a subsidized loan and also whether or not you get a unsubsidized loan. Now there's limits or caps as to how much money you can take out per loan per year. It's very different and it gets into you have to get into the details in order to really understand this. So what are these caps that you keep referring to? Well, if you're a freshman, there is a cap on a subsidized loan of $3,500. So that's the most money that you can get for a subsidized loan. For both combo, meaning a combination of a subsidized and a unsubsidized loan for your freshman year, that maxes out to $5,500. So $5,500 is the max for both. So if you don't qualify for a subsidized loan, then you can get an unsubsidized loan of $5,500. So it's very weird on how that math works, but realistically, your freshman year, you have a max of 5.5 total between both the subsidized and the unsubsidized federal loans. The second year of your undergraduate, or your sophomore year, you're going into your sophomore year, there's a max of a $4,500 subsidized loan and a overall max for both of $6,500 for both the subsidized and the unsubsidized. Again, if you're not qualified for the subsidized, you can get a 6.5 for your unsubsidized. So if you're going in as your junior year or your senior year, the max or the cap is the same. So it's $5,500 for that year for the subsidized loan cap, and the overall, the combo, is $7,500. So as you can see, if you start as freshman, you got 5.5, then sophomore, 6.5, and then junior and senior, 7.5 and 7.5. So it increases the amount or cap as you progress through your college. So which one is better? Well, as you can see, there's benefits and drawbacks on both sides. If you qualify for a subsidized loan, meaning that you have financial need, always take that first. So cap out on that first. Again, as our example, your freshman year, 3.5 for your subsidized loan, and then take out another $2,000 for your unsubsidized, creating your overall cap of 5.5. But definitely go for the subsidized loan first, because there's just that added benefit of not having to pay for the interest rate. So what is the overall interest rate for these loans? Well, it's around 6.5 as of today. So this is the middle of 2025. So as of today, it's somewhere around 6.5. But your circumstance, when you apply or you get the FAFSA or when you get the unsubsidized loan or subsidized loan, can vary drastically depending on what the overall interest rate of the country is. So this year it might be 6.5, next year it might be 4.5, or the year after that could be 7.5. So you have to pay careful attention to which year and which interest rate you're looking at. Depending on what your financial situation is, maybe it's better to sell stocks than to take out this loan, or maybe it's better to pay off large credit card debt than it is to pay for this loan. It depends on your own personal circumstance of whether or not 6.5 is a large amount or a small amount. If you're looking at other loans like Parent Plus loan or bank loans, a lot of those are going to be a higher interest rate than the federal loans, which then brings us back to, do you select this loan over some of those others? Again, that really depends on your circumstance, but I believe when I'm looking at this, this is one of the best interest rates of student loan debt that you can find, and it's also backed by the federal government. And if there are different programs that are helping with federal loans, you're going to get those benefits as well. So there is a lot of benefit of going with this loan first in this tier of how to pay for college. So there you have it. Subsidized loans, unsubsidized loans. We broke them down. We gave you the graphic that kind of breaks it down even further and gives you the details of what the data tells you as what a subsidized loan or an unsubsidized loan is. For your own personal situation, you might want to take advantage of these loans. You might not want to take advantage of these loans. It really depends on your circumstances. But what I do is I rank this as the highest or the best loan to take out during the college season for your student, or for, if you are a student, for yourself. So I believe that this is probably the best or the first loan to go to when looking at how to pay for college. So thank you again. If you really enjoyed this video, or if you learned something about the college application system, please leave a comment or leave a like and subscribe to our channel. We really would appreciate it. Thanks again. This is College Refocus, and we will see you next time. Thank you. Bye-bye.